What if the most dangerous financial time bomb in the global economy isn't sitting on Wall Street, but in Tokyo, ticking quietly beneath decades of low interest rates? And what if this hidden threat, worth nearly $20 trillion, could snap overnight, sending shockwaves through every market you've ever invested in? You may think you've heard every warning about bubbles, debt, or geopolitical risks. But the real story begins with something far stranger: a trade so profitable, so deceptively safe, that hedge funds, corporations, and even governments treated it like free money. They called it the yen carry trade, but it might as well have been a global financial cheat code. Here's how it worked. Japan kept interest rates near zero for years. That meant investors could borrow yen for almost nothing, then convert those yen into dollars, euros, or anything else offering higher returns. If you've ever transferred a credit card balance to take advantage of a 0% introductory rate, you already understand the logic. Cheap money in, bigger returns out. But wait, that's not the whole story. Because this wasn't a few $billion of clever arbitrage. This was massive. By some estimates, trillions of dollars in global assets, from U.S. stocks to emerging market bonds, were propped up by money borrowed in Japan. It was the invisible fuel behind boom after boom. Every year it grew. Nobody questioned it. Why would they? As long as Japan kept rates low and the yen stayed weak, the machine kept printing profits. The danger came from a detail almost too simple. Every borrowed yen eventually has to be paid back. And when enough people all try to unwind their trades at once, selling foreign assets, buying back yen, the whole system can buckle. Prices fall everywhere. The yen surges. Losses cascade. It's like a crowded theater where everyone has to exit through a single narrow door. To see how we got here, we need to go back to the root of Japan's ultra-low-rate world. After its asset bubble burst in the early 1990s, Japan entered what economists still call the lost decades. Growth was weak. Inflation barely existed. To keep the economy alive, the Bank of Japan slashed interest rates all the way to zero. Later, they pushed deep into negative territory. But low rates didn't only influence Japanese banks and businesses. They rippled worldwide. Think of a garden hose plugged into the world's financial plumbing. Japan opened the valve, and capital sprayed across continents. U.S. real estate, European credit markets, Asian equities. Investors kept reaching for anything offering more yield than Japan, because almost everything did. As long as the yen stayed cheap, the carry trade seemed unstoppable. But here's the twist. Interest rate cycles don't last forever. And in 2024, something happened that many traders said they would never see again. Japan began raising rates, slowly at first, cautiously, but enough to break a decades-long pattern. That tiny shift, just a few basis points, was enough to jolt global markets. Suddenly, borrowing in yen wasn't free anymore. Suddenly, traders had to consider the unthinkable. What happens if everyone starts closing their positions? This unwind doesn't move like a normal market correction. It moves like an avalanche, quiet at first, then furious. As investors buy yen to repay loans, the yen strengthens. As the yen strengthens, carry trades become unprofitable. As profits disappear, more traders unwind their positions. A self-reinforcing loop. The same mechanism that inflated global asset prices now threatens to deflate them. And that's where the $20 trillion risk comes in. Because the real danger isn't what's on the books, it's what's off the books. Shadow positions, synthetic trades, derivatives linked to interest rate differentials. All of it built on the assumption that Japan would never change course. It's like building a skyscraper on the belief that the wind will never blow. But the wind is blowing, and the cracks are showing. There's one historical moment that proves how fast this can spin out of control. In 1998, After Russia defaulted on its debt, global investors panicked. A powerful hedge fund, long-term capital management, was heavily exposed to yen carry trades. When the yen suddenly strengthened 15% in a matter of days, the fund collapsed, triggering a coordinated bailout. That was just one fund. Today, the exposure is hundreds of times larger and spread across the entire world. Leave a comment. What's the most important lesson you think markets still haven't learned? But here's the real cliffhanger. The current unwind isn't happening in a vacuum. It's colliding with inflation, geopolitical fractures, and the end of easy money everywhere. And that combination could push the global economy into territory we haven't seen in generations. Because if the yen carry trade was the quiet engine of global growth, its reversal might be the spark of the next global slowdown. And the next part of this story reveals just how the unwind spreads and why no one sees it until it's too late. The first place the unwind hits isn't where most people expect. It doesn't start in Tokyo. It doesn't start on Wall Street. It starts in the thin, fragile space between them, the global funding markets that act like the bloodstream of modern finance. These markets don't make headlines, but they decide who can borrow, who can't, and at what cost. When yen-funded positions begin to unwind, the first domino to fall is liquidity. Investors who once had seemingly unlimited access to cheap leverage suddenly find the faucet tightening. And when liquidity dries up, it doesn't happen like a drought. It happens like someone yanking the power cord out of a machine mid-operation. Everything halts. Spreads widen. Margin calls fire off at lightning speed. Assets that looked solid yesterday start wobbling today. To see why, imagine a trader who borrowed billions of yen at basically 0% interest and used that money to buy U.S. corporate bonds yielding 5%. As long as rates stay stable and the yen stays weak, it's a perfect trade. But the moment the yen strengthens, those same bonds begin to fall in value. The trader is forced to sell, but so is the fund across the street, and the pension fund in London, and the sovereign wealth fund in the Gulf. Suddenly, everyone is racing to unwind at once. Think of a crowded parking garage with only one exit ramp. The more cars try to leave, the slower everyone moves. But here's the problem. Markets don't slow. They snap. The U.S. stock market feels it next. For years, foreign money poured into American equities because they offered higher returns than Japanese assets. But when investors have to repurchase yen, they sell U.S. stocks to raise cash. That withdrawal acts like a vacuum. Share prices sag, not because of earnings or corporate news, but because global capital is being sucked back toward Japan. It's the financial version of a low tide pulling water away from the shore. And while U.S. markets lose capital, Japan experiences something it hasn't seen in ages, a sudden flood of returning money. When investors buy yen to repay loans, they drive the yen higher. A stronger yen means Japanese exports become more expensive relative to global competitors. Companies that built their strategies around a permanently weak yen suddenly feel vulnerable. Their profits shrink. Their stock prices wobble. But wait, there's a twist even deeper than this. The yen carry trade isn't only used by traders chasing returns. Corporations across Asia and Europe have used the same mechanism to finance everything from construction projects to commodity imports. Emerging markets in particular relied on yen-funded debt like an invisible subsidy. When that subsidy dries up, currencies in those regions weaken. Debt denominated in foreign currencies becomes harder to repay. Government budgets tighten, growth slows. This is where history taps on our shoulder again. In 2013, when the Federal Reserve hinted it would taper quantitative easing, emerging markets were slammed. Their currencies collapsed. Capital fled. That event is now called the taper tantrum. But the yen carry trade unwind is larger, more global, less predictable, and fueled by years of leverage that no one fully tracked. Let's take a detour into the psychology of this. Why would professional investors expose themselves to such systemic risk? Because the human brain, especially in finance, gets conditioned by stability. When a trade works for 5 years, it feels safe. When it works for 10, it feels inevitable. When it works for 20, it begins to feel like physics. Investors stop asking if it will break and start assuming it can't. But financial history is clear. The moment a trade becomes universal, it becomes dangerous. Everyone piles in, everyone borrows more. Everyone becomes dependent on the same hidden assumptions. The result is fragility disguised as stability. And that fragility spreads into places no one expects. Consumer credit rates rise, mortgage markets wobble. Banks tighten lending, not because domestic conditions require it, but because their international exposures suddenly look riskier. Even tech startups feel the tremors. Venture capital that once flowed easily slows to a drip. All because the yen, a currency many Americans rarely think about, decides to strengthen at the wrong moment. The irony is almost tragic. Japan spent decades trying to stimulate growth with low rates. Now, the process of returning to normal risks, destabilizing parts of the global economy. It's like trying to pull a needle out of a sweater without unraveling the entire garment. But here's the kicker. The 20th in trillion-dollar number isn't a precise measurement. It's a shadow estimate of how much global financial activity is implicitly tied to the yen. Leverage, derivatives, cross-currency swaps, none of it sits neatly in a single spreadsheet. Regulators don't have a clear map. Banks disclose fragments. Hedge funds disclose even less. It's a blind spot big enough to hide a continent. And the next act is where things get truly tense, because once an unwind reaches the derivatives market, the invisible scaffolding of modern finance, the risks change shape. They become faster, sharper, harder to stop. That's where we go next. The moment when math, leverage, and fear collide. Derivatives are the ghost architecture of global finance, the structures you can't see but absolutely depend on. And when the yen carry trade begins to unwind inside this invisible world, the entire system shifts from pressure to rupture. Here's why. Most large institutions don't borrow yen directly. They use cross-currency swaps, contracts that exchange cash flows in one currency for another at agreed rates. These swaps allow a fund in New York or Singapore to simulate borrowing yen without ever touching a Japanese bank. But these contracts come with conditions. If the yen moves sharply, collateral requirements surge. Suddenly, institutions must post billions in margin. And where do they get that cash? By selling whatever they can, fast. It's a feedback loop with an ugly signature. A rising yen triggers swap losses. Losses trigger collateral calls. Collateral calls trigger asset sales. Asset sales trigger more yen buying. More yen buying pushes the yen even higher. It's a whirlpool, and everyone in it is swimming against the current. In 2020, we saw a tiny version of this dynamic when the pandemic froze global markets. Central banks had to step in to stabilize dollar swap lines. But that crisis was driven by fear and uncertainty. The yen carry unwind is driven by math. No amount of optimism stops a margin call. To understand how dangerous this is, imagine you're running a large fund. On paper, your portfolio looks diversified. U.S. equities, European bonds, Asian real estate, maybe some private credit. But beneath the surface, a huge chunk of your capital is funded by yen swaps you've rolled over for years. Those swaps are now bleeding. Your risk models, built on decades of stable yen behavior, aren't prepared for a sudden spike. The alarm bells ring. Algorithms programmed to limit losses start dumping positions automatically. Bonds that were supposed to hedge your stocks are also falling because other investors are selling them too. Your hedges fail. Your liquidity disappears. And your clients, pensions, endowments, retirement funds, start to ask questions you don't want to answer. This is the moment when financial stress jumps from the trading floor to the real world. Credit becomes more expensive. Companies delay expansion. Layoffs creep into the headlines. Politicians blame each other. But the root cause is still the same. Trillions of dollars of global bets were made on the stability of a currency that is no longer stable. And there's another twist. The yen carry trade didn't just inflate financial markets, it helped shape national budgets. Some governments, especially in emerging markets, issued bonds implicitly supported by foreign investors hunting for yield. As those investors exit to repay yen obligations, borrowing costs spike. Nations suddenly face refinancing cliffs. Political crises often follow financial ones. This isn't the first time currency-driven stress has spilled into politics. In the 1997 Asian financial crisis, collapsing currencies crushed businesses, toppled governments, and shifted the strategic landscape of the region. The yen wasn't the trigger back then, but today, the scale is much larger, and the connections are far tighter. At this point in the unwind, something strange happens. Ordinary people, workers, consumers, families, feel the symptoms without seeing the cause. Mortgage rates climb. A business owner can't secure a loan that would have been approved 6 months earlier. A state government delays infrastructure spending because its bonds suddenly became harder to issue. People see the effects, but not the hidden machinery driving them. In the background, Japan faces its own unintended consequences. A rising yen sounds like good news. Strong currency. Strong nation. But Japan's economy depends heavily on exports. Automakers, electronics firms, and industrial manufacturers all took advantage of decades of a weak yen to dominate global markets. Now, their competitive edge erodes. Profits shrink. Companies warn of tougher years ahead. The Nikkei stumbles. And yet, the Bank of Japan is trapped. If it cuts rates again, it risks inflating domestic asset bubbles. If it keeps raising rates, it tightens the noose on global markets. There is no option without a cost. This is the defining feature of the yen carry unwind. The pain is shared, unpredictable, and multiplied across borders. No single country controls the process. No central bank can easily reverse it. It's the consequence of a financial ecosystem built on a single assumption: that Japanese interest rates would never rise and the yen would never snap back. But assumptions don't stay safe forever. Before we move to the final part, take a moment to reflect. The scale of the yen carry trade wasn't driven by greed alone. It was driven by a world addicted to cheap money. And when a system becomes dependent on the easy path, it rarely adjusts smoothly to the hard one. Now comes the final stage: how the unwind resolves, what history suggests comes next, and what lessons investors and nations can't afford to ignore. When you're ready, say, continue. Every financial crisis has a breaking point, a moment when panic and probability intersect. With the yen carry trade unwind, that moment arrives when policymakers finally recognize the risk is no longer contained to currency markets. It has migrated, it has multiplied, and now it lives at the heart of global financial stability. The first sign comes from volatility indexes. They spike, not because of corporate earnings or geopolitical shocks, but because liquidity, the invisible oil of the market, evaporates. Trading desks start reporting gaps between bid and ask prices. Funds that once moved billions in minutes now struggle to exit even modest positions. It feels like someone turned the lights off in a crowded room. Next comes the policy scramble. The Bank of Japan, after gently nudging rates upward to escape decades of stagnation, finds itself under intense pressure. The yen's surge is too strong, too fast, threatening economic recovery at home and destabilizing markets abroad. But reversing course isn't simple. Cutting rates would look like panic. Maintaining higher rates intensifies the unwind. Other central banks step in. The Federal Reserve opens dollar swap lines, hoping to stabilize funding markets. The European Central Bank signals flexibility. Coordinated statements appear, carefully crafted, designed to soothe nerves. Yet the underlying problem remains. Trillions of dollars of positions need to unwind, and no amount of reassurance changes the mathematical reality that those trades are now unprofitable. Markets enter a strange phase, part fear, part denial. In some corners, bargain hunters appear, convinced the sell-off is overdone. In others, institutions brace for more pain. But history shows the same pattern again and again. When leverage unwinds at a global scale, asset prices don't reset gradually. They lurch. We saw it in 2008 with mortgage-backed securities. We saw it in 2013 with emerging market bonds. We even saw echoes in 2020 when the rush for dollars overwhelmed global funding channels. This time, the spark is different, but the mechanics rhyme. Cheap money created dependencies. Those dependencies became structural, and when the foundation shifts, even a little, the entire building shakes. But here's the part most people overlook. While the unwind causes short-term turmoil, it also forces a long-delayed recalibration. Markets rediscover fundamentals. Companies that relied on financial engineering lose their advantage. Countries that manage debt carelessly confront reality, and investors learn, sometimes painfully, that no trade is permanent. In the aftermath, something remarkable often emerges. Clarity. Economies adjust. New opportunities appear. Capital begins to flow again, but more cautiously and more selectively. The yen stabilizes at a stronger level than before, reflecting a more normalized Japanese economy. The global financial system inches away from its dependence on ultra-cheap leverage and toward healthier, more transparent practices. That doesn't mean the road is easy. Some sectors take years to recover. Others reinvent themselves entirely. But history shows that markets ultimately rebuild from the bottom up, and periods of forced deleveraging often plant the seeds for the next cycle of growth, this time on firmer ground. For everyday investors, the lesson is simple but powerful. Understand the hidden forces behind the headlines. The biggest risks in the global economy aren't always the loudest or the most obvious. Sometimes they sit quietly in a country thousands of miles away, wrapped in a currency few people think about, shaping the world in ways none of us can see until the pressure breaks. And that's why the yen carry trade unwind matters. It's not just a currency story. It's a blueprint for how interconnected and how fragile modern finance really is. When one pillar shifts, the tremors can be felt everywhere. If you've stayed with this story to the end, take a moment and leave your thoughts below. What part of this hidden system surprised you the most? And remember, if you want more deep dive breakdowns like this one, subscribe so you never miss what's shaping tomorrow's economy.